Power moves markets. Capital shapes the world. This is Behind Capital.
March 2008. Long before the collapse of Lehman Brothers, before the rescue of American International Group, and months before the United States launched the Troubled Asset Relief Program, the global financial crisis had already begun, and the first major domino to fall was a powerful Wall Street institution. Bear Stearns, a bank that had survived the Great Depression, a bank that had dominated Wall Street for nearly a century. Yet in March 2008, the entire firm collapsed in just 5 days. This is the story of the first domino of the global financial crisis. Bear Stearns was founded in 1923 by Joseph Bear, Robert Stearns, and Harold Mayer. The firm started as a small investment bank in New York, but over the next 8 decades, it grew into one of the most powerful financial institutions in the world. By the early 2000s, Bear Stearns had become the 5th largest investment bank in the United States. It employed more than 14,000 people and managed assets worth more than $395 billion. Its headquarters stood in Manhattan, inside a modern tower on Madison Avenue. On Wall Street, Bear Stearns had a reputation. It was aggressive, highly competitive, and deeply involved in complex financial markets, especially one market that would later destroy it: the mortgage market. In the early 2000s, the United States experienced one of the biggest housing booms in history. Interest rates were low, credit was easy. Banks were issuing mortgages to millions of home buyers. Many of these loans were known as subprime mortgages, loans given to borrowers with weak credit. Instead of keeping these loans on their balance sheets, banks packaged them into financial products. These products were called mortgage-backed securities. Investors around the world bought them. Pension funds, insurance companies, banks, and hedge funds. Wall Street made enormous profits by creating and trading these securities, and Bear Stearns became one of the biggest players in this market. In 2007, the first cracks began to appear. 2 hedge funds managed by Bear Stearns had invested heavily in subprime mortgage securities. Their names were the Bear Stearns High-Grade Structured Credit Fund and the Bear Stearns High-Grade Structured Credit Enhanced Leverage Fund. These funds were highly leveraged. They borrowed enormous amounts of money to buy mortgage securities. At their peak, the funds controlled more than $20 billion in assets. But when housing prices started falling, the value of their mortgage investments collapsed. In June 2007, lenders demanded more collateral. The funds could not meet the demands. By July 2007, both hedge funds had collapsed. Investors lost nearly all their money. The losses shocked Wall Street, but most investors still believed the damage was contained. They were wrong. By early 2008, the mortgage market was deteriorating rapidly. Banks across the financial system were holding billions of dollars in toxic mortgage securities. But Bear Stearns was particularly vulnerable. Unlike traditional commercial banks, investment banks relied heavily on short-term borrowing. Every day, Bear Stearns borrowed billions of dollars from other financial institutions. This borrowing happened in a market called the repo market, short for repurchase agreements. In this market, banks borrow money overnight using securities as collateral. For Bear Stearns, this market was essential. Every day, The firm needed to borrow around $70 to $80 billion to finance its operations. As long as lenders trusted the firm, this system worked. But once confidence disappeared, the entire structure collapsed. The crisis reached its breaking point in March 2008. Rumors began spreading across Wall Street. Some traders believed Bear Stearns was running out of cash. Within days, lenders began refusing to roll over their repo loans. In other words, they stopped lending to Bear Stearns. This created a classic liquidity crisis. The firm still owned billions of dollars in assets, but it no longer had the cash needed to operate. By Wednesday, March 12, 2008, the situation became critical. Bear Stearns was rapidly losing access to funding. Clients began withdrawing money. Counterparties stopped trading with the firm. Wall Street was losing confidence. On March 13, 2008, Bear Stearns contacted the Federal Reserve for help. The situation was now urgent. If Bear Stearns collapsed suddenly, it could trigger a chain reaction across the financial system. The Federal Reserve decided to intervene. For the first time since the Great Depression, the Fed agreed to support an investment bank. Through JP Chase, the Federal Reserve provided emergency funding to Bear Stearns. This was meant to stabilize the firm temporarily, but the rescue only bought time. Confidence in Bear Stearns had already evaporated. By Friday, March 14th, it became clear that Bear Stearns could not survive. The Federal Reserve and the U.S. Treasury began searching for a buyer. They had one weekend to save the firm, because if Bear Stearns opened for business on Monday without funding, it would collapse. Negotiations continued throughout the weekend. Finally, on Sunday, March 16, 2008, a deal was announced. Bear Stearns would be acquired by JP Chase. The price shocked the world, just $2 per share. Only days earlier, Bear Stearns stock had been trading near $70 per share. The entire investment bank was sold for about $236 million, a fraction of its previous value. The deal required extraordinary support from the Federal Reserve. To make the acquisition possible, the Fed agreed to guarantee $29 billion of Bear Stearns' risky assets. These assets included mortgage securities that investors no longer trusted. Without this guarantee, JP Morgan would never have accepted the deal. In effect, the U.S. government absorbed much of Bear Stearns' potential losses. This decision was controversial. Critics argued it created moral hazard. Saving financial institutions could encourage risky behavior in the future. But officials believed the alternative was worse. A disorderly collapse could have triggered a much larger financial panic. The fall of Bear Stearns sent shockwaves across global markets. It was the first time a major investment bank had collapsed during the crisis. Investors began questioning the stability of other banks, particularly firms that also relied heavily on short-term funding. Among them was another Wall Street giant, Lehman Brothers. At the time, Lehman was even larger than Bear Stearns. But after the Bear collapse, investors began closely examining Lehman's balance sheet. 6 months later, those fears would prove justified. The collapse of Bear Stearns was not the end of the crisis. It was only the beginning. Over the next 6 months, the global financial system continued to deteriorate. In September 2008, Lehman Brothers collapsed. Days later, the government rescued AIG with a bailout worth more than $182 billion. Soon after, Congress approved the $700 billion Troubled Asset Relief Program. The The crisis triggered the worst financial downturn since the Great Depression. Global stock markets lost trillions of dollars. More than 8 million Americans lost their jobs, and millions of families lost their homes. Looking back, the collapse of Bear Stearns marked a turning point. It revealed how fragile the modern financial system had become, a system built on leverage, short-term funding, and complex financial instruments. For decades, Wall Street believed the system was stable. But in March 2008, that illusion shattered. Because when confidence disappears from the financial system, even the largest institutions can collapse, almost overnight. Bear Stearns had survived wars, recessions, and market crashes. Yet it could not survive the crisis of 2008. And when it fell, it became the first domino of the global financial meltdown.